Traders don't fail because trading is hard. They fail because they complicate it. Strategy after strategy, indicator after indicator, endless backtesting, yet zero consistency. The truth is brutal. You don't need more strategies. You just need clarity. And today, I'll show you how one single candle can change your trading forever. In this video, you will learn the one candle scalping strategy, a simple but powerful trading method built around one single candle. How to read price like smart money using the power of 3 market cycle. The 2 one-candle strategy types and exactly how to trade each of them step by step. Real chart examples on Forex and crypto to show you how this strategy works in live market conditions. Exact entry rules, stop-loss placement, and take-profit targets using liquidity levels. The 3 golden rules you must follow to protect your capital and stay consistent. How to use this strategy for scalping on the 1-minute timeframe or day trading on the 15-minute timeframe. This strategy works on all markets: Forex, crypto, indices, futures, metals, and options. By the end of this video, you will learn a simple and profitable trading strategy based on one single candle, know exactly how to enter and exit trades with precision using liquidity, be able to predict market direction before it happens, and trade with confidence. Before we begin, if you get value from real trading strategies and not useless theory, make sure you like this video, subscribe to the channel, and hit the notification bell so you don't miss the next powerful lesson. Let's get started. First of all, I want you to agree with one simple fact. Every candlestick on your chart tells a story. Take this bullish engulfing candle, for example. It shows that buyers completely overpowered sellers. When this happens at a key support level after a liquidity sweep, that's not a random move. That's a shift in order flow. It tells us buyers just took control and price is now likely to move higher. Now look at this bearish pin bar. This candle also tells a story. It shows a battle between buyers and sellers. Buyers tried to push the market up, but sellers stepped in aggressively and forced the candle to close lower. In the end, sellers won that battle. When a bearish pin bar forms at a major resistance level after a stop hunt, it reveals smart money rejection and a high probability move to the downside. So here's the lesson. Every single candlestick carries information. If you learn how to read them correctly, you'll stop guessing and start trading with precision. That's how you go from a confused trader to a confident market reader. Now, take a look at this single candle. Let's say it's a bullish candle with a clear high and low. If we take this candle from the 1-hour time frame and mark its high and low, we now have a price range. And when we drop to a lower time frame, like the 5-minute chart, this one candle becomes 12 candles of market structure. That means this single candle is not just a candle, it's a complete story of accumulation, manipulation, and expansion hidden inside it. And if you stay with me until the end of this video, I'm going to show you exactly how to use just one candle to make high-probability trading decisions with sniper-like precision. So powerful that even professional traders will wonder how you saw the move before it happened. Before we move forward, you must understand something essential. The market is not random. Price moves in a repeating cycle, and this cycle appears every single day on every time frame. It can be broken down into 3 phases: accumulation, manipulation, distribution. These 3 phases form what is known as the power of 3, a smart money principle that explains how big players control price before driving it in one direction. Alright, let's kick things off with phase 1, the accumulation phase. This is where smart money quietly enters the market and builds positions. Price ranges sideways, creating what looks like consolidation or indecision. Retail traders avoid this phase because it looks untradeable, but this is exactly where professionals prepare. Price stays inside a tight range. Liquidity builds on both sides. Institutions take time to enter without moving price. This phase is simply preparation for a larger move. Now things get interesting. Phase 2, manipulation. Once enough liquidity has built up, institutions trigger a false move. Price suddenly breaks out of the range, but that breakout is a trap designed to grab liquidity. This move is called a liquidity sweep or stop hunt. It exists for one purpose: to trap retail traders and collect their stop-loss orders so smart money can fill positions at the best price. Alright, now let's break down the psychology behind the trap. First, breakout traders get baited, they enter in the wrong direction. Then existing traders get wiped out as their stop-losses are triggered. Meanwhile, institutions quietly absorb all that liquidity, loading their positions before launching the real move. Now comes the moment everyone waits for. Phase 3, distribution. After liquidity is collected and weak hands are trapped, smart money unleashes the real move. This is the acceleration phase, where price moves aggressively in the true direction. The stops are gone, the liquidity has been taken, institutions are locked in and ready. Now the market moves fast, clean, and with unstoppable momentum. This is the move we want to catch, not the trap, but the institutional move that follows. Now you might be asking yourself, what does one single candle have to do with the power of three? Great question, because this is where everything comes together. Once you understand this connection, you will never look at a candlestick the same way again. That one candle isn't just a candle, it's a map. It's a higher time frame signal that shows you where smart money is operating. The high and the low of that candle create a range, and that range tells you exactly where price is likely to react, where liquidity is sitting, and where the real move will begin. But here's the secret most traders never realize. Inside that single candle, on a lower time frame, the entire power of three is unfolding step by step. Here's how it unfolds. Inside the high and low of that candle, price is moving sideways on the lower time frame. This is smart money accumulating positions quietly, building orders without revealing direction. During this phase, liquidity builds above the high and below the low of the candle, creating a range. Then price spikes outside of that range, grabbing stop losses and trapping breakout traders. For example, when you see a pin bar that breaks below the candle low and closes back above it, that is a clear liquidity sweep. If you switch to a higher time frame, you will still see this liquidity sweep, but it will be hidden inside just one candle wick. On the higher time frame, this move is only visible when you mark the previous candle's high and low, and then observe the next candle that creates the liquidity sweep. After liquidity is captured, price returns inside the range, and the third candle drives price in the opposite direction. This confirms the liquidity sweep and begins what we call the distribution phase. If you drop back down to the lower time frame, you will see this phase as a strong acceleration move. This is where momentum begins and the real move starts. Alright, now let's jump into a real chart example so you can actually see how this one candle and the power of three work together in live market conditions. We're looking at the Euro, US dollar on the 1 hour chart. Here's our anchor candle, you mark the high and the low. That immediately gives you your range. Now watch what happens next. The very next candle breaks below the low, but look closely, it closes back inside the range. That is a major clue. On the higher time frame, this tells you manipulation just happened. This is the liquidity sweep phase of the power of three. Now let's zoom into the 15-minute chart to see what actually happened inside that 1 hour candle. And just to be clear, I'm only using the 15-minute chart here for illustration purposes to make the power of three easier to see. In the next examples, we'll use the 1-minute chart, which is what I actually recommend for scalping. This strategy works perfectly for scalping and day trading. You just adjust the execution time frame. So inside that 1 hour candle, first we had accumulation, price moved sideways creating a small consolidation. That's smart money building positions. Then we got manipulation, price spiked below the range, sweeping stop losses sitting under support before snapping right back inside. Classic stop hunt. Here's how you would trade it. Entry. After price closes back inside the range, confirming the liquidity sweep is over. Stop loss, below the wick of the sweep, for tight risk. Take profit. Target the high of the 1 hour range, which now acts as liquidity. And look what happens next. Price rockets straight to target. Clean setup, no confusion, no indicators, just pure price action with smart money logic. This is exactly how one candle works hand in hand with the power of three. And this is just one example. Once you learn how to read a single higher time frame candle as a roadmap and then zoom in to execute on a lower time frame, you'll start spotting these setups over and over again. Now that you understand the foundation, stay with me, because I'm about to show you exactly how to trade this step by step using a high probability scalping strategy. Alright, now let's shift gears and talk about the two types of one candle trading setups you're going to use in this strategy. First up, type 1, the classic 3 candle setup. This is the foundation setup. You'll see it over and over again across all time frames. Forex, crypto, indices, stocks, it doesn't matter. The logic stays the same. Let's start with candle 1, the anchor candle. This candle sets the range. Its high and low become your key levels. This is your king candle, the candle that controls everything that follows. You mark it and you trade around it. Now we move to candle 2, the manipulation candle. This is where smart money makes a move. Price creates a false breakout above or below the anchor candle's range to grab liquidity and trap retail traders. This is usually a pin bar or a wick rejection candle designed to trigger stop losses. Finally, we reach candle 3, the reversal, also known as the execution candle. This candle explodes in the opposite direction after the liquidity sweep. This is the candle you want to ride for profit. But here's the key. You don't enter on candle 3. You position yourself before it forms, right after the manipulation is confirmed. This setup is simple, clean, and incredibly powerful once you know how to execute it. Alright, time for the second setup of the one candle strategy, the inside bar trap. The second setup is based on the inside bar pattern, and it works beautifully with our one candle strategy. Here's how it works. You have one strong candle, and then a smaller candle forms completely inside its range. That smaller candle is your inside bar, a sign of market indecision and hidden accumulation. You simply mark the high and low of the first candle. That's your range. The inside bar shows the market is coiling, building energy before a move. Then watch what happens next. Price fakes a breakout of the range, grabbing liquidity. It snaps right back inside, that's your confirmation. Then it reverses hard in the opposite direction. That's your entry. The breakout is the manipulation. The snapback is your signal. The reversal is your opportunity. This is one of my favorite setups because it works in trending markets and ranges, and it fits perfectly into scalping or day trading. Now let me show you a real chart example so you can see exactly how we trade this setup in the market. We're on the British pound US dollar 15-minute chart. First, we identify a strong candle that becomes our leading indicator candle, also known as our anchor candle in this strategy. We simply mark the swing high and the swing low of that candle. Those are now our key levels. The swing high acts as resistance and the swing low acts as support. Clear and simple. Now watch what price does. Price breaks below the support, below the swing low. But instead of continuing lower, it closes back inside the range. That right there is a sell-side liquidity sweep. What does that mean? It means smart money just grabbed liquidity from breakout sellers who chased the move down. Once that liquidity is collected, price is likely to push higher, at least back toward the swing high, where the next area of liquidity sits. Now, let's zoom in to the 1-minute chart, which is our execution time frame for this 15-minute setup. Look closely, the exact same thing happens again. Price breaks below the same level, sweeps liquidity, and snaps right back inside the range. Another sell-side liquidity sweep. This is important. When the same signal repeats across multiple time frames, that is confirmation. The market is telling you, liquidity is cleared. The path is now open for price to move higher. Here's exactly how you take this trade. Entry, at the close of the 1-minute candle that re-enters the range. Stop loss, just below the liquidity sweep wick. Take profit, the 15-minute swing high, the high of the anchor candle. This strategy is simple and powerful, but let's be real, nothing in trading is 100%. This isn't a holy grail. You must use a stop loss and protect your capital, but when you combine the one candle strategy with solid risk management, even one clean scalp like this can produce a high reward to risk trade. And that's how you grow your account consistently. Now listen carefully, there are 3 golden rules to the one candle strategy. Follow these and you'll avoid fake setups, skip emotional trades, and build the consistency every trader dreams of. Break them and the market will remind you why discipline matters. Rule number 1. Follow the timeframe execution model. This strategy is built on higher timeframe bias plus lower timeframe entry. Identify the one candle on the 15-minute chart. Mark the high and low of that candle to define your range. Wait for the liquidity sweep. Don't enter before it happens. Then drop down to the 1-minute chart to execute your entry. This method keeps your analysis clear and your entries precise. Higher time frame tells the story. Lower time frame gives you timing. Rule number 2. Never take a trade unless it offers at least a 2-to-1 reward to risk ratio. This is how you protect your account and stay profitable long term, even with a normal or average win rate. Remember, risk management always beats win rate. Let me make this simple. If you risk $10 on a trade and you lose, you only lose $10. That's your risk, or what we call 1R. But if you win with a 2-to-1 reward to risk ratio, you make $20. That means your winners are always twice as big as your losses. So even if you only win 50% of your trades, you will still make money over time because the size of your winners is bigger than the size of your losing trades. That's why reward to risk matters more than win rate. Rule number 3. Don't force trades. Patience is your edge. If the market doesn't give you a clean setup with a clear liquidity sweep, skip the trade. Forcing trades brings losses. Wait for high-quality setups. They stand out clearly when you see them. Now, let me show you a practical chart example on the British pound, Japanese yen, using the 15-minute time frame. Here we have our one candle indicator setup. First, we mark our support level here and our resistance level here to define the range of the market. Then we wait. Notice what happens next. The second candle breaks above the resistance but closes back inside the range. That is a clear buy-side liquidity sweep. It tells us the market just trapped breakout buyers and is now likely to reverse back down, at least for one strong move. Alright, this is where the one candle strategy really activates. One candle on the 15-minute chart represents 15 one-minute candles. So now we drop down to the 1-minute time frame to refine our entry with precision. On the 1-minute chart, price spikes above the 15-minute resistance again and then closes back below it. That confirms the liquidity sweep and this candle becomes our entry trigger. Here's exactly how to trade it. Entry: at the close of this 1-minute candle. Stop loss: just above the high of the 15-minute candle. Take profit: the next support level from the 15-minute time frame. In this trade, we risked 10 pips to target 21 pips. That's a 2-to-1 reward to risk setup, exactly what we want. And look at what happens next. Price drops cleanly to our target just as planned. Zero stress, no hesitation. If you showed this trade to someone before it played out, they wouldn't believe you. Why? Because almost nobody knows how to read price like this. This is your secret weapon. With this strategy, you're not guessing. You're reading liquidity and trading like smart money does. Now let's move to another real chart example, this time on Solana, using the 15-minute time frame. Before we continue, understand this. The one candle strategy works on every market. Forex, crypto, stocks, indices, metals, futures, you name it. The market changes, but the behavior of liquidity and manipulation stays the same. Here we have our one candle leading indicator, so we mark the high of the candle as resistance and the low of the candle as support. That gives us our trading range. Now we wait for the liquidity sweep. Look at what happens next. The very next candle breaks below support but closes back inside the range. That is a clear sell-side liquidity sweep. It tells us smart money just cleaned liquidity from breakout sellers below the range, and price is now likely to move higher. So now we drop to the 1-minute chart to execute our entry. On the 1-minute time frame, price breaks below the range again and then closes back inside it. Another liquidity grab. That candle becomes our entry trigger. Here's exactly how to trade it. Entry: at the close of the 1-minute candle, that re-enters the range. Stop loss: just below the low of the sweep candle. Take profit: the next 15-minute level. Look what happens next. Price moves straight to the target exactly as expected. This setup delivered 4.5 R. That means if you risked $100, this single trade returned $450 in profit. That's the power of following liquidity and trading with smart money, not against it. That's how the one candle strategy works. Simple, powerful, and built on real smart money concepts, not indicators or guesswork. If you found value in this video, make sure to like it, subscribe to the channel, and turn on the notification bell so you never miss the next strategy breakdown. We're just getting started. Stay focused, trade smart, and I'll see you in the next video.